Hello, good evening, and welcome to How to Identify Market Trends Through Chart Patterns. In this webinar, you will get detailed introduction to charts and chart patterns, learn how to analyze patterns on charts, establish market trends, find out more about risk management. Charts are the most important tool in your understanding of the total sum of what's happening in the market. It's simply a visualized representation of the price movements. A reflection of the psychology of the market and visualization of the interaction between buyers and sellers, and shows how the market values a particular asset based on the information available. Because of this, it's considered to be one of the most important tools in the arsenal of any trader. There are three major charts: bar charts, candlestick charts, and line charts. We will get into more details with the candlestick charts in the next webinar, since they are the most commonly used charts amongst active traders. Identifying a chart patterns is a form of technical analysis, and technical analysis is just a method for trying to forecast the ups and downs of the market. Research has proven that some chart patterns have high forecasting probabilities. The trend is what technical analysts are looking for in their charts. Chart analysis is based on the theory that prices tend to move in trends and that past price behavior can give clues to the future direction of the trend. The purpose of chart analysis is to identify and evaluate price trends with the objective of profiting from the future movement of price. Different chart patterns can be classified as either continuation patterns or reversal patterns. Continuation patterns are called that because they generally will continue the direction of the trend. For example, if a stock is in uptrend and then pauses or enter into a period of consolidation, trading is temporarily confined to a well-defined pattern or range. The expectation is that the market will ultimately break out to the upside and to continue the direction of the trend. If the trend was down prior to the consolidation, the expectation would be for the stock to break out to the downside and continue the direction of the downtrend. Rectangles, flags, pennants are the most common continuation patterns. Reversal patterns have a tendency of reversing the trend. These consolidation patterns can signal a reversal in both uptrends as well as downtrends. The head and shoulders pattern, which includes the inverted head and shoulders, double top, and double bottom, are typically identified as reversal patterns. Wedges can act as both continuation patterns and reversal patterns as well. The preceding trend and the slant of the wedge make it easy to identify which is which and what direction the ensuing move is likely to be. Symmetrical triangles, ascending triangles, descending triangles can form either on an uptrend or downtrend and can signal either a continuation or reversal. Market behavior can be predictable to a certain degree based on what prices have done in the past. However, Nobody can predict exactly what a specific market will do at a precise time in the future. The true professional traders will tell you that market analysis is not a business of prediction, but one of probabilities. For many traders, going with the probabilities means analyzing charts to find patterns that reflect what people have done in similar situations in the past. Human behavior and price history tend to repeat themselves, and from the tracks that prices leave on a chart, one can extrapolate the probability of predictable patterns of a price behavior. The trend line is one of the most basic, most powerful trading tools. The first advice many new traders give is to identify the trend. A respected technical analyst, John Murphy, says about trend lines: the importance of trading and direction of the major trend cannot be overstated. The danger in placing too much importance on oscillators by themselves is the temptation to use divergence as an excuse to initiate trades contrary to the general trend. This action generally proves a costly and painful exercise. The oscillator, as useful as it is just one tool among many others and must always be used as an aid, not a substitute for basic trend analysis. To draw trend lines, it's like much of technical analysis. It is more art than science, no hard and fast rules. But a trend line is one of those things where you know when you see one of them. An uptrend is defined as a series of higher highs and higher lows. A downtrend is defined as a series of lower highs and lower lows. A trend line is a straight line that connects two or more low or high price points and then extends into the future to act as a line of support or resistance. The first 2 points establish the trend line while additional points validate it. In the slide, you can see an uptrend line as a positive slope and is formed by connecting more than two low points. The uptrend line acts as support as long as prices remain above the trend line. The uptrend is considered intact. The key to trend line analysis is what the market does as it approaches trend line. The assumption is that a trend is in motion, will stay in motion until it doesn't. Breaking through a trend line is an important signal that one trend may be ending and another beginning. Like you can see here, breaking of uptrend line and breaking of downtrend line. To negate a trend line, prices must penetrate the trend line, resistance or support, and then see follow through things or weakness during the next trading session. However, if prices make a big push above or below the trend line, then the trend line is negated without needing follow through information. Several chart points can provide support or resistance, but the most accurate method to determine support and resistance levels is to look at a chart. and its past price history, and then see at what price levels the highs, lows, and the closes seem to be touching the most. This method works on any time frame, intra-day, daily, weekly, or monthly. Trend line support and resistance is very useful to you, and projecting this trend line to determine future support and resistance area is extremely effective. Finally, psychological price levels can be significant support and resistance areas for some markets. These are usually round numbers that catch the attention of traders. For example, in crude oil, psychological price level might be 100. For gold, it might be 1,300. From a trading perspective, the key to support or resistance level is how the market acts as it approaches that level. Will the market respect that level and turn back from it as you would expect if it is a strong support or resistance area? Or will the market run through that level, negating whatever influence that support or resistance might have had? It's important to note that when a key support level or zone is penetrated on the downside, that level or zone then will likely become key resistance. So support become resistance. Likewise, a key resistance level or zone that's penetrated on the upside will then likely become a key support level or zone. Let's start talking about some classic chart patterns. We'll start by triangles or bullish triangle that shows two converging trend line as price sears lower or stable highs and higher low, or actually lows. Volume diminishes as the price swings back and forth between an increasingly narrow range, reflecting uncertainty in the market direction. Then, well, before the triangle reaches its apex, the price breaks out above the upper trend line with a noticeable increase in volume, confirming the pattern as a continuation of price up trend. Triangles can also appear during a downtrend to signal a bearish continuation when the price penetrates the lower trend line. That can also be seen as top or bottom patterns making and marking a trend reversal. A bullish continuation wedge consists of two converging trend lines. Unlike the triangle where the apex is pointed to the right, the apex of the pattern is slanted downwards at an angle. This is because prices edge steadily lower in a converging pattern. That means there are lower highs and lower lows. Over the weeks or months, this pattern forms. The trend appears downward, but the long-term range is still upward. Volume should diminish as the pattern forms. The pattern is confirmed when prices break above the upper trend line. The bearish counterpart appears with converging trend lines pointing slightly upward. A bullish flag follows a steep rise in price called the flag put. Often the reaction to a positive announcement is marked by two parallel trend lines around a period of consolidation that occur as excitement subsides and volume decrease. The flag can be horizontal or slightly downward. Finally, the price breaks the upper trend line, marking the resumption of the uptrend. Bearish flags can be spotted during a steep drop in price with the flag horizontal or slightly upward. Patterns are similar to flag, however, the trend line are converging rather than parallel. The double bottom pattern marks the reversal of a prior downtrend. So this time, it's reversal of the trend. The price forms two lows at roughly the same price level. For a more significant reversal, look for a longer period of time between the two lows. Volume reflects a weakening of the downward pressure, tending to diminish as the pattern forms, with some pickup at each low. Less on the second one. Finally, the price breaks out above the highest high to confirm the bullish signal. Strong volume on breakout is always a good sign. You can see here the volume actually is high. The double call is bearish counterpart, marking the topping out of an uptrend and initiation of a downtrend. The triple pattern starts with prices moving downward, followed by three sharp lows, all at about the same price level. Volume diminishes at each successive low and finally bursts as the price rises above the highest high, confirming the pattern as a sign of bullish price reversal. A triple top is the bearish counterpart, signaling the reversal of a prior uptrend to form a new downtrend. The head and shoulders bottom, also called reverse head and shoulders, is created by three successive declines in the price, followed a significant downtrend. The lowest low, that is the head here, is in the middle, flanked by two higher lows, that shoulders, at roughly the same level. Volume is highest as the price makes the first two decline, then diminished through the right shoulder. Finally, volume surges as the price closes above the neckline. And the neckline we can draw between the two highs to confirm the bullish reverse. The head and shoulders top is the bearish counterpart that signals a major trend reversal downward. Following a downtrend, the rounded bottom forms a gradual bowl shape, reflecting a gradual shift in the balance of supply and demand. Volume tends to mirror the price pattern, decreasing as bearishness wanes and investors become indecisive following a period of relatively inactive or inactivity in the market, and at the bottom of the barrel, the price pattern starts its upward turn as sentiment becomes more bullish. Volume tends to increase, and the bullish pattern is confirmed when the price crosses above the moving average, and the outcome sees volume reach a climactic peak in a few days of nearly vertical price movement on the chart. Diamonds patterns usually form over several months. In very active markets, volume will remain high during the formation of this pattern. The pattern begins as prices create higher highs and lower lows. In a broadening pattern, then the trading range gradually narrows after the highs peak, and the lows start trending upward. The direction of the peak out signals the resolution to a new trend, upward or downward, out of the diamond's boundary line. This pattern can mark the assumption of a prior trend of continuation diamond or a significant trend reversal that can be diamond top or bottom. And now, if anybody have any questions about chart patterns, I'm waiting your questions. If anyone have any questions, please try to. Okay, so you still have chance to write the questions as the end of this webinar. But now, I guess nobody has any questions. So it's the risk management systems. And I'm going to explain some systems you can use in binary options trading with examples. And first one will be Martingale system. Martingale system is a risk management system of a negative progression and consists in doubling the trading size in case of the loss. For example, if you trade $1 and you will win, you can trade another $1 in the next trade. But if you trade $1 and you will lose, you should trade $2 on another trade. If you will lose again, you trade $4 and so on until you will have finally won. Then you are returning to your basic trade size. That's in this example $1. And this is a clear example you can see. But for this trading system, all of them actually, let's assume that the chance of winning every event is 50%. And the bookmaker's odds is 2. And you will win after 6 rounds. It is quite a bad luck. The probability of not winning in 5 rounds equal 1 per 32. But remember, it still can happen. It means that you had to trade, like here, $1. If you will lose, you will trade $2, then 4, and next trade will be 8, then 16, then 32. Till 1. So your last stake, the winning one was 32. And you win 64. So $1 more than you had to stake. That's how it works. Anti-martingale system, also called Paruli, is a system of positive progression. It is based on increasing the stake only in case of win. If you are going to use the anti-martingale strategy, you should think about your overall plan. You need to decide exactly how many times you want to win in a row until you start over with your initial trading volume. I think three winning in a row seems to be a good choice. So in case of 3 winnings in a row for the first lot, you should restart your initial size of trading again. Martingale strategy is decided as designed actually to take advantage of winning stakes. If you are lucky enough, you can win more money than in case of flat risk management. Anti-martingale strategy may be appropriate for those traders who have a small initial bankroll, but like every risk management system, it is not expected to make you a winner in a long run. And in this example, initial trade will be $1 and you win. So you trade $2 and you win. So you trade $4 and you win. But you start again from $1 and you win, and $2 if you decide. So you can start from beginning. And if you will lose, also you will start from $1. Before I go to this system, still Grand Martingale system, this same as normal martingale system, but when you lose and double your trading volume, additional volume size is added. I do initial volume size. 1326 system is a positive progression system similar to the Paruli system or anti-martingale system. The main premise of the system is that you may win 4 times in a row. In the first step, you invest, for example, 1 unit. In second, 3 units. In the third, 2 units. And finally, in the fourth step, 6 units of money. If you lose at any step, you start all over again at 1 unit, then 3 units, and so on. The odds should be close to 2. And the winning chance of a signal trade should be close to 50%. So let's calculate it with this example. The odds of every event, 2, and you trade $1, you win $2. You trade $3, and you have to add $1 extra. After you close your previous trade, you win $6. You trade $2, you take down $4 from the trading amount. You win $4. You trade $6, you have to add $2 extra. It's like this. Clear that if you lose the first trade, you will lose $1. If you lose your second trade, you will lose $2. One from the first trade and one from second one. If you lose your third trade, you will win $2. If you lose your fourth trade, you will be breaking even on the board. Fibonacci system is based on sequence of numbers in which every number is sum of previous two numbers. I got questions and I will answer all of questions after I finish with the risk management system. He is asking about 1326 risk management. It's the chance for losing in this. It's usually to save your money of your account. So in this example, as you can see, we paid only one amount of 1 unit of money, with 3 units, with 2 units, and 6 units. First unit, we win. So we can have one scenario for winning the 4 trades. So it will be win 2, then 6, then 4, then 12. But if you lose in any step, like you lose in first trade, you will lose only $1. But in second one, you will lose $2 because you will lose 1 from the first and 1 from the second. And then, if you will lose in third, it means that you win in first and second. You win when you trade 1 and 3, and then you lose in second. So overall, you will win $2. If you lose your fourth, you will be breaking even on the whole. I think it's clear, and it doesn't need anything, just to have the odds of every event are equal to, and the chance of winning of single trade should be close to 50%. In Fibonacci system, based on sequence of numbers, and every number is sum of previous two numbers. So the numbers look like this: 0, 1, 1, and 2. 2 is sum of 1 and 1. And 3 is sum of previous number: 5, 8, 13, 21, 34, 55, and so on. When you lose each time, you lose around. You increase the trade size on the next. And just like in the martingale system, but instead of doubling it, you follow the Fibonacci sequence. For example, start by trading 1 unit. If you lose, first trade 1 unit. If you lose second time, trade 3 units, then 5 units, then 8, and so on. When you win around, you don't end the sequence at once, like in the martingale case. Instead, you cross out the last 2 numbers in sequence and trade the new number. The sequence ends once you are back to trade 1 unit again. Now, for example, you trade 13 units and you win. You cross out 13 and 8. Your next trade is 5 units. If you win again, cross out 5 and 3, then trade 2 units. In this example, You trade $1 and you lose. So you trade $1 again and you lose. You trade $2 and you lose. You trade $3 and you lose. You trade $5 and you win. So you cross out 5 and 3. And then you trade $2. And if you lose, you trade $3. And if you win, cross out 3 and 2. And then you trade 1 and sequence and start over with 1 unit again. The Lombard system is called after 18th century French physician called the Lombard. This system is based on the basic belief that in the long run, two events of approximately equal probabilities will happen roughly the same number of times. We must add or subtract the established basic unit to the stake, depending on the result of previously. It's not this complication. It will be easier with example. The trading size should be decreasing after the winning trade and increasing after the losing trade. The difference between the Lombard and the martingale system is that you don't have to double your trading size if you lose. So your trading size won't grow so rapidly, and that's the main problem with martingale system. So in this example, if you trade $1 and you win, the trading size remains the same. You trade $1 and you lose, the trading size increases. You trade $2 and you lose, the trading size also increases. The trading size now is 3. And if you lose, the trading size will be increased. And you trade $4 now and you win, trading size will decrease to 3. And if you lose, you will increase back to 4. So decrease on win and increase on loss. There is also reverse Dalmert system, and it is the Lombard system in reverse. Increase on win and decrease on loss. And remember, in all of these systems, the odds should be close to 2, and the winning chance of a single trade should be close to 50%. And now, if anybody have any question. Write for me, please, if you can't understand anything. Yeah. Somebody's asking about last part. I don't know if he means the Lombard. The Lombard system, you increase one loss and decrease on win. So if you trade, for example, 1 unit of money, for example, $1, and you win, so you will trade 1 again. But if you lose, you increase 1, so it will be 2. This example, I think it's very clear. 1 win, it's okay, so that's the unit I trade with. But if you lose, you will increase it to cover your loss next time or next trade. But if you keep losing, so you will increase it by another 1, and so on. But if you lose, you don't start by 1 again, but you decrease it. So now when you win in this $4, you will decrease also by 1. So now it's 3. But if you will lose, you keep increasing it. That's the system, and I think it's the easiest one. And reverse the invert is when you win, you increase it, and when you lose, you decrease it. It's clear like this. Any other questions? Mhm. So I guess nobody has any questions. So to request information on my free and advanced webinars, please go to my website, eg-academy.webs.com or egbinary.webs.com. You can contact me directly. My email address is gmail@gmail.com. I'd like to thank you for attending today's webinar. We will hold following webinar using candlesticks in binary options trading on 17th of April. So please stay posted on my web pages for binary.com and hope to see you on my next webinar. And meanwhile, if anyone will think of any question later, please don't hesitate to contact me through my email. I will be more than happy to answer all of your questions. So goodbye and see you next time. Have a great evening. Bye-bye.